Welcome to This Explainer. Today, we're going way beyond the typical surface-level advice you hear about moving to the US, and we're delivering an expert, analytical breakdown of the actual structural and financial mechanisms required to survive the integration process. Look, we're looking directly at the underlying architecture here, the incredibly strict legal, tax, and corporate rules that operate entirely behind the scenes. This isn't just about general tips and tricks. This is a deep dive into the exact cause and effect relationships that will dictate whether your new life and your business footprint will fundamentally succeed or fail under immense regulatory scrutiny.
Okay, so we're going to break this down into 4 core pillars today. 1, global taxation mechanics. 2, corporate financial infrastructure. 3, capitalization and legal status. And finally, 4, compliance and data security. Let's get right into it.
Section 1, Global Taxation Mechanics.
So, our first critical area tackles what is absolutely the most common, and honestly the most dangerous, implicit assumption that incoming residents make about their tax liability. The system doesn't care where your money lives, it only cares where you live. This mechanism essentially erases your financial borders the very moment you enter the tax system as a resident. What this means in practice is that a rental property back home, a tiny childhood savings account in another country, or international stock dividends, they all instantly become domestic income in the eyes of the government. Expert analysis shows that this mechanism is specifically designed to prevent offshore sheltering. So any unexempted foreign income is going to be subjected to tax calculations at your highest domestic marginal rate.
Now, you might be operating under the perfectly logical yet completely incorrect assumption that only your domestic earnings are going to matter. But here is the really harsh systemic reality. Even if you owe absolutely zero actual tax, say because of foreign tax credits, the strict informational reporting of those foreign assets is mandatory. Period. Failing to file a simple informational form about a foreign account can trigger automatic 5-figure penalties before you've even earned a single dollar domestically. And this applies equally across the board. Even individuals who obtained citizenship by birth, left the country at a very young age, and currently hold dual citizenship without ever having lived or worked here, well, they remain legally bound by this exact same global taxation mechanism.
Moving right along to Section 2, Corporate Financial Infrastructure.
Stepping past individual taxation, we have to look at the structural framework required to actually establish a corporate entity. And setting up this infrastructure demands a very specific, totally inflexible sequence of events. You can start with step 1 and register a formal entity at the state level, but systemically speaking, that business is practically invisible. Step 2, acquiring a 9-digit federal tax identification number, is the absolute master key here. It's mandatory, because without this specific identifier, step 3 is completely locked down. You can't integrate with domestic payment processors, you can't set up software-backed domestic banking, and you certainly cannot run payroll. So skipping that federal identifier cuts off access to cutting-edge financial infrastructure entirely. It essentially cuts off life support to your business before it even takes its first breath.
So you set up a formal entity like an LLC or a corporation to shield your personal assets from business risk. Makes sense, right? That's just basic logic. But the systemic trade-off here is severe. The second that corporate shield goes up, it triggers a direct cause and effect requirement. You now absolutely must file highly complex, continuous structural informational returns. And the paradox is pretty wild. The system does not care if the company's owner is physically residing on a beach, thousands of miles away in a totally different hemisphere. The mere existence of that domestic entity strictly anchors you to domestic filing deadlines and rigorous corporate transparency laws.
Let's talk about the $100,000 mark. While basic accounting or simple transfer accounts might be totally fine in the very early days, expert analysis consistently indicates that surpassing the $100,000 revenue threshold triggers a massive operational bottleneck. At $100,000, basic manual spreadsheets aren't just annoying, they become a severe liability trap. The sheer volume of transactions at that level necessitates fully software-integrated domestic banking.
Why is that absolutely crucial? Because an automated, perfectly accurate ledger isn't just a nice convenience for your bookkeeper anymore, it is literally your only defense if you face a sudden year-end federal audit. Let's dive into Section 3, Capitalization and Legal Status.
This is where we analyze the highly complex intersection of your financial capitalization and actually procuring legal work status. Securing your legal right to work basically means proving your economic utility to the system. You have to show federal adjudicators that you aren't just taking up space, you are actively stimulating the domestic economy. How do you do that? Well, it can be achieved by proving extraordinary professional milestones, like securing significant venture funding on a global scale. Or, let's say you're utilizing an intercompany transfer from a foreign headquarters to a domestic branch. In that case, you must prove a bulletproof, unbroken structural and financial link between those two corporate entities. The system adjudicates based on hard, verifiable economic impact. Good intentions simply don't count here.
And there's that $100,000 number again. But let's look at it this time from the perspective of immigration. Now, while there isn't always a strict legal minimum written into every single statute, injecting at least $100,000 into a domestic corporate account acts as the ultimate systemic proof. It proves to adjudicators that the corporate entity is highly viable and that it can comfortably fulfill statutory minimum wage requirements for its sponsored personnel. And yes, that includes the founders themselves. It essentially takes a speculative, optimistic business plan and replaces it with cold, hard, verifiable data.
Now, here's a really non-obvious assumption that a lot of new arrivals make. They naturally assume that this required capital has to come entirely from their own personal wealth. Actually, scratch that, it doesn't at all. Systemic rules explicitly permit this required capital to originate from foreign venture capital, angel investors, or other institutions. The underlying mechanism actually cares significantly less about the exact origin of the dollars, and it focuses almost entirely on the fact that the capital is actively being deployed to meet specific statutory economic goals right there on domestic soil.
Which brings us to our final pillar, Section 4, Compliance and Data Security. We need to talk about the hidden tripwires of the system, the non-obvious compliance triggers and operational security mandates. For example, a simple change of address. It might seem like just a bit of minor administrative paperwork, but systemically, it is a high-wire act. You have exactly 5 days to execute a federal address update. Just 5 days. Why is the window so aggressively tight? Because the federal tracking system relies on continuous, unbroken paper trail continuity. Missing a mailed legal notice simply because you moved 6 days ago and didn't update the database can automatically default your legal status. Administrative friction like that can literally and very quickly trigger deportation proceedings. Entering the workforce locks you into mandatory electronic verification systems. Think of this like a massive, interconnected web that simultaneously queries multiple federal databases to verify your exact biographic data. Every single receipt number, every admission record, and your birth date, it all must match flawlessly across all participating agencies. A single clerical mismatch, even something as incredibly simple as transposing a digit on an intake form, that can trigger an automated red flag that freezes your employment eligibility indefinitely until it's manually resolved.
And if you happen to operate a business in specialized fields within this system, like tax preparation or financial services, authorities don't just ask if you did your job correctly, they demand hard proof. Strict due diligence is absolutely mandated by law. During sudden mandatory federal compliance examinations, authorities will pull exactly 25 of your client files, no warning. You must produce the physical or digital worksheets proving you actively verified your client's eligibility and data. You can't just take their word for it. The burden of proof rests entirely, 100% on your meticulous record keeping. Furthermore, merely holding a corporate tax identification number basically paints a giant target on your back for cyber threats. Systemic regulations demand incredibly strict cyber hygiene. We're talking encrypting all client data and tightly securing all employment tax records.
If an unauthorized party manages to access your W-2 records, ignorance is definitely not an excuse. You are legally mandated to execute immediate mitigation protocols. And get this, that includes legally paying to provide credit monitoring services for every single exposed person for up to 2 years, straight out of your own pocket. A simple, preventable data breach instantly becomes a massive, crushing financial liability.
Ultimately, this expert briefing really underscores a core truth. Operating within this environment demands an uncompromising, highly proactive approach to strict filing rules and data security measures. The system operates entirely on automated triggers and rigid statutory deadlines. It simply does not factor in a lack of awareness or your status as a new arrival. Saying, "I didn't know," is never, ever accepted as a valid defense in a federal audit. You are fully expected to align perfectly with every structural requirement right from day one.
So, we've deeply analyzed the mechanics today, from the vanishing borders of global taxation to strict capital triggers and unyielding compliance webs. And really, it leaves us with one major thought. The question isn't just whether you have a great business idea or a really strong work ethic. The real question is this: is your foundational infrastructure truly robust enough to handle the full, crushing weight of these systemic obligations? Because in this system, structural integrity isn't just a best practice. It is the literal prerequisite for your survival and success. Take a hard look at your blueprints and ask yourself, are you built to withstand the scrutiny?